All right, chapter 12 is statement of cash flows. So this is the last of the four financial statements. We've been dealing earlier in the semester with the income statement, the statement of retained earnings, and the balance sheet. That's what we did on midterm 1 and midterm 2. And so this is the last of the four required financial statements that all publicly traded companies must provide in their annual reports. So the statement of cash flow is quite simply a reconciliation of the increase or decrease in cash. It takes the first line on the balance sheet, classified balance sheet under current assets, the most liquid of all the assets, cash, and tells the readers of the financial statement what uses and sources, where did the cash come from, and what did we use it for. All right? Now, cash is a broad term. It is normally classified as cash and cash equivalents. Cash equivalents includes things that can be instantaneously turned into cash. Money market accounts, savings accounts, commercial paper, U.S. treasuries, and the like. So it is a broad category, not just cash in a checking account or cash in the cashier's box. Okay? The statement of cash flow is extremely important to readers of the financial statements because if you remember to our very first week, companies have to do two overarching goals. They have to make a profit. And then the second thing that they have to do is maintain liquidity. You have to have cash on hand in order to pay your bills when they come due. Because the day that you have to go to your employees and tell them that payday is not going to happen Friday is an ugly day indeed. And you do not want to be in that position. So this is the statement that tells the readers of the financial statements, the users of financial statements, as to how well the company is doing at generating cash from their operations. It is broken into three sections: operating activities, investing activities, and financing activities. Now, the data for this financial statement comes from the income statement and the balance sheet, and it is a comparative balance sheet. The balance sheet at the end of last year and the balance sheet at the end of this year. You must have both years in order to be able to complete one of these financials. Operating activities is, and we're going to be doing, there's two ways of doing a statement of cash flows. There's a direct method and an indirect method. I'm going to be focusing on the indirect method. I'm going to demonstrate on the second day that we're doing problems. I'm going to demonstrate what the direct method is so that you see it. But what I'm testing on and what I'm hoping that you understand is how to do this in an indirect method. The only difference between the two is this first section, operating activities, how you calculate cash used or provided from operating activities. That's the only difference between the two methods. The investing activities and the financing activities are the same under both approaches. All right? So operating activities. Operating activities are the income statement and current assets and current liabilities. So it's net changes in the current assets, net changes in accounts receivable, net changes in inventories, net changes in prepaid rent, prepaid insurance, office supplies, Current liabilities, the net change in accounts payable, salaries payable, taxes payable, interest payable. All right? So the items on the income statement, which I'll talk about here in a second, plus any net changes in current assets and current liabilities, feed the operating activities section of the statement of cash flow. Yes, sir?
Are liabilities under expenses or other liabilities for the...
Liabilities on the balance sheet. This is all off the balance sheet.
Items on the income statement plus assets.
Plus current assets and current liabilities. All right? Investing activities are the net changes in the rest of the asset side of the balance sheet. So this is net changes in property, plant, and equipment. Because if you go out and you buy new equipment, that's an investment. If you go out and buy a patent or a trademark or something along those lines, an intangible asset. If you go out and buy some natural resources, those are investing activities. So that section is going to be net changes in the rest of the asset side of the balance sheet. And the rest of the balance sheet other than the current assets, because current assets we used in operating activities. And that leaves financing activities. Financing activities is the rest of the liabilities section, long-term liabilities. So if we go out and we borrow more money or we sell a new bond, that's a financing activity. If we go out and we sell some new stock in stockholders' equity, sell some new common stock, that's a financing activity.
So basically operating activities is anything inside the business that run the business.
That's our day-to-day activity. And so the accounts that are affected daily are current assets and current liabilities. That's what we do every day. Property, plant, and equipment is investing, long-term, and then financing is long-term liabilities plus stockholders' equity. That's how it breaks down. All right, here's an example of the net income, starting with net income. So this is Amazon.com's cash flow, statement of cash flow for years ending 2007, 8, and 9. We know that this is an indirect method because it begins with net income. We're then going to make adjustments for non-cash expenses that are included in net income. So depreciation, deferred income taxes, they've got some other items in here. These don't affect cash. And then we do the changes in operating assets and liabilities. So inventories, accounts receivable, accounts payable, accrued expenses. And that gives us operating activities. They bought some fixed assets under investing activities. They acquired some other companies. They had some investment in marketable securities. And then they sold some, and then they purchased some additional marketable securities. So that's the rest of the asset side of the balance sheet. And then financing, they had some tax benefits, common stock that was bought back, some treasury stock. They borrowed some long-term debt, and then they repaid some long-term debt. And that was their financing activities. All right? So, as I said, operating activities are net income plus any non-cash expenses or anything that is a non-operating. So if you sold for a gain some property, plant, and equipment, that's not an operating activity. That's not something you're doing on a daily basis. That's an unusual transaction. So you would add back any gains or subtract any losses, okay? So you would make any adjustments for gains and losses of property, plant, and equipment. And then you would go to the current assets and current liabilities. So think this through. A net change in a current asset. Accounts receivable, for instance. If accounts receivable goes up from the beginning of the year to the ending of the year, if the balance in accounts receivable goes up, how does that affect cash?
Cash goes stay the same or goes down.
No. Cash goes down. Because what's happening? Your customers are not paying you. So you've got to come up with the cash in order to continue to fund your business. So current assets, changes in current assets, have an inverse, an opposite effect to cash. If inventories go up, what does that mean? You're buying more inventory, putting it in stock. That costs you cash to buy that additional inventory. So any changes in current assets has an inverse relationship. So an increase to accounts receivable will be a negative adjustment to cash. What about current liabilities? If accounts payable goes up, what does that do to cash? Cash goes up also, because if accounts payable goes up, you're not paying vendors. You're saving the money. Well, it's just a source of cash. So if accounts payable goes up, taxes payable goes up, wages payable goes up, that is an increase to cash. So that has a direct relationship. As one goes up, so does cash. So current assets, inverse relationship. Current liabilities, direct relationship. Okay? Investing activities. This is the rest of the long-term side of the balance sheet, of the asset side of the balance sheet. So purchase and sale of property, plant, and equipment, long-term assets, long-term investments, things like that. All right? So this includes the sale as well as the purchase. Financing activities is long-term debt plus stockholders' equity. All right? So what we're going to do when we approach this to solve a statement of cash flows is we're going to, first thing, take the balance sheet, and we're going to get a net increase or decrease on every account in the entire balance sheet. So all of the current assets, all of the property, plant, and equipment, all of the intangible equipment or intangible assets, all of the current liabilities, all the long-term liabilities, and all the stockholders' equity section. Operating activities are the sale of goods to customers, receipt of interest on dividends, on loans or investments, and the sale of trading marketable securities. Those are all cash inflows. This is what we're doing on a daily basis. This is our operations. Payments, cash outflows, are payments to wages to our employees, payments to our vendors for inventory, payments to pay general expenses like utilities and insurance and things like that, paying of interest, paying taxes, and to buy any short-term marketable trading securities. Investing activities, inflows come from the sale of property, plant, and equipment, the sale of short-term marketable securities and long-term investments, and any collections of loans that we lent to other people. So long-term receivables, loan receivables. Outflows include buying new property, plant, and equipment, buying new long-term investments, and making loans to other people. And then the last section, financing. Inflows consist of issuing new debt in the form of bonds or mortgage payables or long-term notes payable, or selling stock to investors. Outflows is buying back stock, in the case of treasury stock, repaying those loans, and paying dividends. As we pay dividends to the shareholders, that is a financing activity. There are transactions that do not involve cash, but then normally affect two types of sections in the cash flow statement. If you go out and you buy land, 100% debt, you sign a new mortgage on that land for 100% of it. There was no cash down payment. That's really two things. No cash changed hands, but you acquired some land. That's an investing activity, all right, that goes in that second section. That's a new purchase of property, plant, and equipment. And you had a financing activity, the issuance of new debt. So you have two things going on there, even though there was no cash that changed hands. All right. So the operating activities is where does the company derive the cash flows that feed its net income? What do they do with that profit that they generate on an annual basis? Where are they expanding? What kind of new equipment are they buying? And then how do they manage their financing? Do they sell new stock, or do they use OPM, other people's money, by borrowing it? So the way to do that is we'll start with the operating activities, then we'll do investing, and then financing, and that gives us the statement. So here's an income statement. We have net income of $16,000. In here, there is included depreciation expense of $37,000. That's a non-cash expense. We paid the cash when we bought that equipment that we're now depreciating as an investing activity. There's also two items in here that are not operating in nature. We had a gain on sale of investments for $12,000, and we had a loss on sale of plant assets for $3,000. That's not what we get up in the morning to do. We're not in the business of buying and selling plant assets. So that's non-operating in nature. So you need to back that out of operating activities. Then we take a look at the comparative balance sheet. All of the current assets, all of the investments, all of the property, plant, and equipment, the current liabilities, the long-term liabilities, the contributed capital, and the retained earnings, and they've got a treasury stock account. And we look at what the changes are. So cash went from $15,000 up to $46,000. Plant equipment went from $505 up to $715. Long-term debt went from $245 up to $295. So we look at each one of those. The current assets section and current liabilities go to the operating activities. The investment in plant assets, investing activities. The long-term liability and all of the common stock are financing activities. So that's the breakdown. We'll be doing the indirect method. So indirect method is you start with net income. You make reconciliations, adjustments for non-cash or non-operating. So we'll add back the depreciation. We'll add back the loss on the property, plant, and equipment. And we'll deduct that gain on investments. Then we'll add or subtract changes in current assets and current liabilities. Current assets will have an inverse relationship. If accounts receivable goes up, we will reduce cash. If accounts receivable goes down, we'll increase cash. All right? So, 16,000. Add back the 37,000 of depreciation. These are our adjustments to reconcile net income to net cash flows from operating activities. We add back the $3,000 loss on sale of plant assets, and we subtract the gain on sale of investments. Then we go to the current asset side. Accounts receivable decreased. If accounts receivable goes down, that means your customers are paying you. That's a plus. That's a positive effect to cash. Plus 8,000. We had an increase in inventory. That means we're buying more inventory to have in stock. That is a reduction in cash. We had a decrease in prepaid expenses, whether it's prepaid rent or prepaid insurance or whatever.
Would that be an increase?
That is an increase in cash. That went down, so cash goes up. Current liabilities. We had an increase in accounts payable. If accounts payable goes up, cash goes up. So that's a positive $7,000. We're not paying our vendors. We had an increase in accrued liabilities, whether it's accrued interest or accrued taxes or whatever. That is a positive to cash. And then lastly, we had a decrease in income taxes payable. The only way to decrease income taxes payable is to send the government the cash. So that negatively impacted cash. Add all those adjustments up. Add the 37 plus the 3 minus the 12 on down that whole column there, and you get a net change of $14,000.
So if you have like an increase in accounts receivable, then that's a decrease in cash.
That would be a decrease in cash. That means your customers are not paying you. Absolutely. Add the 14 to the net income. Net cash flows from operating activities is $30,000. All right? That's the first of the 3 sections. So this is just the changes. Inverse relationship, a decrease in a current asset frees up cash. Current liabilities, an increase in current liabilities frees up cash. Direct relationship with current liabilities, an indirect relationship with current assets. So any depreciation expense is an add, any amortization or depletion, add back any losses and subtract any gains. All right, investing activities. This is the rest of the asset side of the balance sheet. So if you think about it, you buy some new investments. All right, that's a long-term investment. When you bought it, you debited investments and you credited cash. That is a use of cash. So cash flow is purchase of investments, negative $78,000. We sell some plant assets for $5,000 in cash. Now we had already removed the loss, the $3,000 loss. We'd already taken that out up in the operating section. So the only thing that goes in here is the cash proceeds. Sale of plant assets, $5,000. Excuse me. And then the last section is financing activities. Financing activities is the rest of the long-term liability section and any changes in stockholders' equity. So we had a non-cash. We issued $100,000 in bonds in exchange for some plant assets. Now this is where I'll differ from you, and the way I'll solve it on next Monday and Wednesday is they put down at the bottom, kind of a footnote at the bottom, said schedule of non-cash investing and financing activities, and say issue of bonds payable for plan assets. I don't. I break it up. I think it's more informative to the readers of the financial statements because you do have an investing activities purchase of plan assets. It should go into that section rather than putting it down at the bottom. So we'll be doing this, presenting this a little different than what this slide shows. All right. You paid back $50,000 of bonds. That's a repayment, a negative financing activity. You issued 15,200 shares of $5 par value common stock for a total of $175,000 in proceeds. Issuance of common stock, $175,000. And then lastly, we paid dividends back to the shareholders for $8,000. Payment of dividends. Now I'm going to stop right there. If all I gave you was the income statement with net income on it and the comparative balance sheet, could you calculate how much dividends are? If I gave you the beginning balance of retained earnings and the ending balance of retained earnings, you subtract the two. So if I go back to that comparative balance sheet, let's look at it. All right. Retained earnings went up $8,000. All right. It started the year at $132,000. It ended the year at $140,000. So if you had that information plus the income statement of $16,000, how much did you pay in dividends? $8,000, because that's what decreases retained earnings. So on your final exam, if I give you what the change in retained earnings are, and I also tell you how much net income is, the difference between the two is dividends. And that's a financing activity. Okay? Go back to it. And then the last thing that's a financing activity is they had an increase in treasury stock. So they bought back some of their own stock. So that's a purchase of treasury stock. That is in the stockholders' equity section. It is part of that last of the three sections on the statement of cash flow. So here's the statement of cash flow. It starts with net income of $16,000. We add and subtract non-cash expenses plus any non-operating gains and losses. And then we do changes in current assets and current liabilities. That gave us net cash flows from operating activities of $30,000. Investing, we bought some new investments of $78,000. We sold some investments for $102,000. We bought some new plant assets for $120,000. I would put here $220,000 because we had that non-cash exchanging bonds for plant assets. So when I do this on Monday, it'll say purchase of plant assets $220,000. And then we sold some plant assets for $5,000 in cash. That is net cash flows from investing activities because that's a use. So net cash flows from investing activities of $91,000. Then we had repayment of bonds for $50,000. We issued some new common stock for $75,000, $8,000 in dividends, and we bought back $25,000 of treasury stock. That's net cash flows from financing activities of a positive $92,000. If we take the 30 minus the 91 plus the 92, we get a net increase in cash of $31,000. The cash started the year at $15,000, it ended the year at $46,000. And that's the reconciliation of cash. Does that make sense? We're going to have lots of opportunities. I'll be doing some problems on the board starting Monday, and then we'll go through and give you a chance to do some in your groups.
So the next test is gonna have three questions, right?
It'll have a bond question,